Now, we've had more evidence today of the UK's improving economic performance. Official figures confirm that three key sectors, services, production and construction, are expanding, offsetting a slowdown in household and government spending. The final estimate of GDP for the 3 months to June showed expansion of 0.7%. The Office for National Statistics also revised up its growth figure for the first 3 months of the year from 0.3% to 0.4%. And Britain's positive message seems to be spreading abroad, with official figures showing that the proportion of UK quoted shares owned by overseas investors has passed the 50% mark for the first time ever. Well, joining me here at the Gherkin is Alpesh B.Patel, the Chief Executive of asset management company Brythinian Partners. Nice to see you back on the show, Alpesh. Thank you for coming in. I suppose whichever way you look at this, this is a positive statement, is it not, about Britain showing international confidence?
I think it's more positive than people realise, because it means that, you know, all these complaints we've had about the banks not lending to British businesses, great, that hole has been filled by foreign capital. Foreign capital is more than happy to lend to British companies, but not only that, foreign companies want to list in the United Kingdom. So for all our sort of beating down about the British economy and so on, actually they're falling over themselves to invest and list over here. I just came back from India. More companies list in London, Indian companies list in London than any other exchange in the world outside of India.
The thing I found really encouraging was that it's not just the usual American suspects who are buying into London, because they've always done it. Something like 25% of all foreign owners of British shares come from Europe.
And not just from Europe. Let's not forget the new rich in Asia. All the big asset management companies setting up in China, in places like India, of course. But not only that, we say London because we're talking about the London Stock Exchange. These companies are all over the place. Yep. If you look at a company like Tata, which owns Jaguar Land Rover, those are jobs in Birmingham. Those are jobs around Britain, including Northern Ireland, which is often forgotten, of course.
Indeed. But given our economic problems, and let's not forget that debt is up to about 90% of GDP. What is it about Britain that these people find so attractive?
Well, we are part of, let's not forget, the world's largest trading zone. The EU is a $14 trillion market. It's as large as the United States in terms of population and GDP. And the United Kingdom is, politics aside, at the heart of it, economically, because we're one of the largest economies. It's a great passport for exporting into the EU. That's one thing. And growth. We do actually have growth. We are a major economy, and we have strong connections with the rest of the world from the United Kingdom. So for all the things that we hear about, particularly in party political season, about transportation and all these things, actually it works incredibly well. It's a very easy place to do business.
You know what I found really disappointing, though, about these figures? If you dig into them, while foreign investors have been buying into UK quoted shares, domestic pension funds have been selling out. How about this for a stat? So UK pension funds owned 32% of UK shares in 1992. Today they own just 4.7%.
Don't forget, it's not that they're actually selling out. What they're doing is diversifying, and that's partly demand-led by pensioners who realise that they don't want to be concentrated in purely UK stocks. In a global economy, you do want to be owning American shares, you do want to be Australian and so on, because it diversifies. It also means you can streamline out those cycles that you might get in one economy in particular. That's part of it, but also because you're talking about proportions. If their percentage has gone down, that's partly because foreign percentages have increased as those other companies, those other countries and their pension funds want to have some of the biggest companies in the world, and some of the biggest companies are, of course, listed here in Britain.
All that said, hasn't there been a problem here? And it's this, that the pension regulator, which is so powerful today, it has bullied a lot of pension funds into getting out of equities into so-called safer bonds, just as, frankly, over the last couple of years, we've had a terrific rally in share prices, and a lot of that upside has been missed.
You're absolutely right that regulators should not be stock pickers. I mean, God knows, fund managers, some of them shouldn't be fund managers either in terms of their poor performance. But that issue of timing is a short-term issue that the regulator, you could say they called it wrong. Well, actually, they weren't looking at timing. The fact of the matter is, our fund managers should be far more diversified, as should the average viewer. They should not just be living and earning from Britain and then only having shares in Britain. They should be earning their income from people working out in other countries, and it's so much easier to do now than ever before. And so it is a good thing that those pension funds do diversify, but actually the bigger problem with our pension fund industry is the poor performance of the fund managers. It's not got to do with the underlying companies, it's just that they end up only being able to buy into a few companies because they have so much money to manage because they're so good at marketing, and those few companies don't then perform. I don't want to bang on about how poor the banks have performed, but that's what ends up happening.
On that very point, what about the behaviour of investors? Because for many years I've heard the claim, the protest that in this country, professional investors, they're just short term. You know, they think the long term is something after lunchtime. Is there any evidence that foreign investors are more patient and are more long term?
I haven't seen any evidence to suggest that. But one thing that we do know is that if you've got a diverse base of capital, then you're less reliant, as a company, that you're less reliant on one or two big investors who could pull the plug. At least if you've got a broad shareholder base, and that's what you want as a British company, you want a broad shareholder base. So if somebody moves around, changes their mind after lunchtime, at least you've got a lot of shareholders and no one shareholder has too much control over you. But it's a balance, because we don't want the companies thinking they can run roughshod over the shareholders, especially when those shareholders are pensioners. We do need more protection for pensioners within the pension funds, and that means keeping a very close eye on the performance of pension fund managers to make sure they do deliver returns.
There we are. You have been warned, all you poor performers. Alpesh B.Patel, nice to see you. Thanks for coming in.
Thank you.
Next on Jeff Randall Live. The not so big switch. Just how many customers have changed banks?